Hey everyone, and welcome to another episode on Wealth Strategy Secrets. Today we are joined by Byron Elliott. Byron is a founding partner of Three Pillars Law and the Chief Vision Officer of REI Keyholder Limited. He's an experienced attorney and business owner who has supported real estate syndicators through acquisition, due diligence, closing, entity formation, and private equity offerings. He has successfully supported syndication deals in the self-storage, multifamily, RV park, manufactured housing, mobile homes, residential assisted living, and mixed-use asset classes. As Chief Vision Officer of REI Keyholder, he provides the direction on the investment strategy for the organization, delineates roles and responsibilities of team members, and creates strategic partnerships and interacts with public officials. Prior to practicing law and investing in real estate, Byron served a 24-year career in the Army with assignments in Korea, Germany, Kosovo, Iraq, and multiple stateside assignments. Byron, thank you for your service, sir. It's so good to see you.
Thank you, Dave. I appreciate the opportunity.
Yeah, absolutely. So I think probably what would help the audience who's not really familiar with, you is to just really kick off a little bit on your background, Byron. If we could start things there.
Absolutely. I appreciate that. So I'll talk about kind of where things transitioned from my service. So my wife and I attended University of Denver Sturm School of Law together, College of Law. Graduated back in 2012 with the intent to hang a shingle. My wife's got a very strong leadership background and very strong administrative background. And then my undergraduate and graduate degrees were in business. So we felt like we could take that leap of faith and start our own little firm. And then funny enough, while we're waiting for the results from the bar exam, I get a recall to active duty for the Army for another 5 years. And so we ended up hanging a shingle, a small general practice here in the north side of Denver, in a little town called Commerce City. And she basically was carrying the water on the legal side of the house for the first 5 years we were in business. Family law, civil litigation, kind of the standard stuff you'd expect in a little bedroom community. And then as I was easing into retirement, I had the opportunity to learn a little bit about private equity raises, how they apply in real estate investing. And so as I was looking to transition from active duty, I did an internship in a self-storage company, a fast-growing self-storage company, and basically learned how to do private equity raises and all of the due diligence stuff that goes along with purchasing a piece of real estate. And so our firm pivoted pretty hard to, that's about 90% of the type of work that we do now. Most of our clients are first, second, third time syndicators. We've got a handful of bigger clients who have done hundreds of millions of dollars in deals, but just really have landed in a nice sweet spot, a place where we really enjoy the legal work and really enjoy the clients that we're working with.
Yeah, that's excellent, Byron. And how about family for you?
Yeah, so I'm married. We've got 4 kids between us. My oldest son is 26 and he's down in Miami. He's a real estate agent. So he's been actively participating in real estate. And I've got 3 teenagers in the house that are driving me crazy right now. But yeah.
At least you didn't have triplets, right? So that they were all at the same time, which is what I have.
Oh, wow. That's impressive. Yeah.
So awesome. No, thanks for sharing that. Really, really appreciate that. A lot of our listeners, Byron, a lot of folks are new really to, syndications, this space and private equity, right? And like everybody else, everyone was drinking the Kool-Aid of conventional wisdom and really talking to financial planners in terms of, hey, this is, how we're going to build our wealth, right? So as it kind of delve into this whole world of private equity and syndications, maybe it would be helpful from your expertise and, from the legal purview to really talk a little bit about the syndication. If you can give us a little bit of background from the Jobs Act, how the syndication really came out, what is a syndication, and maybe talk a little bit about the Regulation D exemptions.
Yeah, for sure. And I have a lot of the same experiences probably as the people that you're talking about. And so, it's kind of this natural progression we see with our clients where, everybody understands that real estate's a great investment. So, somebody typically buys, let's say an investment property, a single family home, they want to do short-term rentals or a duplex, quadplex, something like that, right? And you do that multiple times. And at some point, your personal balance sheet culminates and you can't borrow money from a conventional lender anymore. The next kind of progression is partnering up with somebody so you can kind of piggyback their balance sheet, purchase more property. But again, at the end of the day, unless this is a huge capital provider, your balance sheet between you and your partner or your joint venture is going to culminate. And this is where people get into understanding and using private equity, so raising money to be able to invest in larger projects. And so syndication really, it comes out of the Securities Act of 1933. So in the Securities Act of 1933, of course, you're coming off the Great Depression, you're coming off an era where people are running around swindling money from other people, making bold claims about the type of returns they're going to get. And so the Securities Act kind of policed that up, right? And so highly regulated, the Securities and Exchange Commission, highly regulated in terms of raising money and investments generally, but they've carved out this neat opportunity for people who want to raise private equity. And so you mentioned Reg D, there's two rules under Reg D that allow people to raise private equity without having to register with the SEC. And that's Rule 506B and 506C. And so high level, one of the big things that the SEC is looking for in allowing these exemptions is still, as a matter of public policy, making sure that investors are informed and at a minimum sophisticated enough to understand the type of deal that they're investing in. And so what you'll see is very common. The first handful of times that people are doing a private equity raise, they'll do a 506B raise. So 506B, it has some opportunities and it has some constraints. So what 506B allows you to do is raise money from up to 35 non-accredited but sophisticated investors and an unlimited number of accredited investors. And so we talk about that real quick. What's an accredited investor? Generally, people are looking at $1 million in net worth, not including the equity that you have in your personal residence. Or in lieu of the net worth, you're looking at compensation on an annual basis. So if you're a single person, $200,000 in the last 2 years with a reasonable expectation to make that again this year. If you're married, $300,000 last 2 years, again with a reasonable expectation to make it again. And so what 506B allows for is for you to bring in non-accredited investors. So a lot of times people are looking at a friends and family round, right? So they're doing a smaller equity raise. They want to raise 25 grand a pop from up to 35 of these non-accredited investors. However, the onus is on the issuer or the sponsor to determine if there's a certain level of sophistication with these investors. So even though they don't have the net worth and they don't have the income and have met that threshold, if they show a certain level of sophistication, then they can participate in one of these private equity deals. And so unfortunately, there's not a bright line rule as to what that level of sophistication is, but you're going to do a factor by factor analysis. So you're going to take a look at, education, generally speaking, how educated is the person? You take a look at life experience. You take a look at investing experience. For my clients, I ask them to, query the prospective investor on what is their experience in real estate? How much experience do they have in? And so what you're doing then is on an investor by investor basis, you as the sponsor are taking a look and again, just making sure that that investor is sophisticated enough to understand the deals, right, that they're looking to invest in. And truly that they're, not in a financial position where if the deal goes south, that they're relying on that income, right? And that's what the SEC is looking for. We don't want people investing in deals. And if they lose their money, like that's it, right? Bankruptcy, foreclosure, those are the things that we're trying to guard against. In these 506B offerings, the investors actually verify their own accreditation status. And so what I advise our clients is to come up with a simple questionnaire. And the questionnaire is really threshold. Question number one is, are you an accredited investor? Yes or no? And then we give them the definition. And then I go into some questions that kind of flesh out that level of sophistication. And so I'll have the investor actually fill it out. The other piece is you have to have a pre-existing relationship. And this is something where people get confused. They think that in a 506B offering, the pre-existing relationship requirement only applies to the non-accredited investors. It's not true. It's the investors across the board to which you're going to pitch your deal. So that's a pretty important thing, pre-existing and substantial relationship. And so that's why it's a pretty popular vehicle for that first kind of friends and family raise if you're going to purchase a piece of real estate.
And what does that look like, Byron? A pre-existing substantial relationship in your definition? How would you define that?
Yeah, so it's great. Again, no bright line rule, right? So that's why people pay attorneys to try to interpret these kind of nebulous rules. And so I'll give you two scenarios. Like, let's suppose that you and I meet at a real estate conference for the first time, and we meet at the Thursday night, the typical Thursday night happy hour. Hey, Dave, I'm Byron. We get to know each other. We share some experiences. You tell me about Pantheon. I tell you about REI Keyholder and the firm, right? The next morning we have breakfast or lunch or, dinner, whatever it may be. But over the course of those 2.5 days, if we've had enough of a rapport and enough communication where, again, big picture, I can ascertain whether or not you are sophisticated enough to invest in one of my deals, if you're a non-accredited investor, then that's pre-existing and substantial enough in my book.
Yeah.
Some people will suggest there's a cooling off period. And so from the time you meet somebody initially until the time you show them an offering, maybe that's a month, maybe that's 2 months. Everybody kind of approaches that a different way. The one bright line rule is you can't publish your offering and then go out and try to create a pre-existing relationship, which is more common than you'd think. And so the other piece that's kind of confusing for people on occasion is what constitutes the actual offer that's being made, right? And so some people will think that, okay, I publish a PPM and an operating agreement and I have a webinar and I push out a pitch deck. So now my offering is live, and that's the line in the sand where you can no longer establish that relationship. At the end of the day, if you're actually socializing deal details prior to that without the official publication, that could constitute an offer, right? And so you have to be kind of mindful about that. And the timing of the publication of the offer is important, especially if you're relying on a 506B exemption. You want to make sure that you've done your socializing, your networking, you've built your investor database, you've talked to people enough times. That way you have sufficient schlitz when it comes to investor money prior to actually making the offer, right? Does that make sense?
Yeah, makes perfect sense. As opposed to a 506C, right? Which can be publicly advertised, correct?
Right. And so that's, again, just in terms of the natural progression, people get through a handful of deals, they cut their teeth on let's say a first multifamily complex, they go full cycle on a deal, whatever, they start to develop a track record and maybe a name for themselves in this industry. And so now they have a deal and you can actually openly solicit. So this is where you probably see a lot of message traffic on LinkedIn, you get Facebook, you get email campaigns, you get postcards, all of that stuff. That's all fair game.
Yeah, got it. Now that makes sense. And I appreciate that background because, again, I think this is new for a lot of people. And along those lines, something else that I think is probably weighs on LPs' minds. I know it was on my mind, right, as I started to get into the space, and you get excited to do an investment, and then we get this stack of documents, with the PPM, right, and looking at all these documents, lots of legalese in there. What are some of the key things that LPs should be looking for when they're reviewing the PPM and signature docs?
Yeah, so you've probably heard this a number of times, but the very first thing that a passive investor, I think, is going to look at is what's the management team, right? The sponsor of the offering, who are those players and what's their level of experience? And so a typical team in this realm, you've got, a CEO type or a CVO type. You've got an acquisitions type who's, running the financial model, taking a look to make sure that the deal actually makes sense and can give the kind of returns that you're looking for. You have an ops type who's going to actually, take control of the operations of the facility to implement whatever business plan that you have. And you probably have a marketing person in investor relations, right? Those are the typical kind of functions for most of the operators that I see. And some may handle all that stuff internally. Some may, partner up with other co-GPs for some of those responsibilities and some of those tasks, or some may be outsourced. But at the end of the day, those are kind of the 5 things that you're looking for. And I think you want to make sure that whoever's serving in that role is competent, right? They've got a track record, ideally in the type of project that they're doing. You will have some people who are, sponsors for the first time, and you take a look at their level of education and you take a look at their success in whatever endeavor they've been in, right? So you've got to do some due diligence on these sponsors. That's the most important piece. That's like step 1. The second piece that you take a look at a lot of people want to go straight to, well, what's the carried interest or what's the promote? What's the sponsor getting, right? In exchange for me investing my money in the deal. And so a lot of passive investors will go straight to, the waterfall. What's the distribution section look like? What do I get in terms of a preferred return, right? And how am I prioritized in terms of distributions from cash and then distributions at some form of liquidity event? And so it's very common for an LP to go take a look at, okay, is the sponsor giving up, 70, 80% of the equity in the company? That's kind of typical for first-time sponsors. But I would suggest that really depends on the nature of the deal and the experience and track record of that sponsor. And so, again, it's kind of a natural progression where people who are doing this for the first handful of times, maybe they've got a background in construction or they've got a background in property management, but the first time that they're doing a private equity raise, you're typically looking at something like an 80-20 split or 70-30 in favor of the passive investors. And then you take a look at, in that waterfall, how are you incentivizing the sponsor to get paid, right? And so when I talk to clients about a PPM, I'm looking at a whole bunch of different levers that we can pull that both incentivize investor money to come in, but also create alignment between the sponsor and the investor. And so what I mean by that is, let's say you start out with a typical 8% preferred return and some sort of 70-30 split, right? That's very, very common. But you may incentivize performance for the sponsor by putting in there some form of hurdle where, it's either the investor gets some sort of equity multiple or they get an IRR hurdle, whatever it may be. So as long as the sponsor meets these certain economics, now it gets more favorable for the sponsor, right? And so as an LP, you want to take a look and see how am I being incentivized to bring money in, and then where's the alignment in terms of the distribution section. A lot of times you'll look at fees, right? So the fees that are customary in, I'm just going to use real estate deals because that's, that's the majority of our stuff. But let's suppose you have, value adds a big typical real estate play, right? Either a value add or you're finding some property that's underperforming for some reason. It could be either poor management, lack of marketing and advertising, deferred maintenance, mom and pop have run it, they just don't raise rents, right? It's underperforming for however many reasons, and you can buy this property on the cheap, implement your business plan, sell it off 4 or 5 years later. That's pretty typical, right? But over that 5 years, there's different activities that are taking place on the sponsor side of the house. And so what I mean by that is, on the front end, there may be a heavy lift in terms of the value add component. And so the sponsor's having to work with a general contractor, or maybe they're trying to GC it themselves and they're working with subs. You're working with a lender. Like, it's constant communication to get the renovation done as soon as possible. So in that scenario, it may be customary to take a project management fee or some form of developer fee, right? Or if you're doing it in-house, a construction management fee. But then once everything is leased up and stabilized, those activities aren't taking place anymore. So perhaps that fee goes away. So I think passive investors will look immediately at what's the fee structure for the deal, right?
Right. And just a point on that. I mean, I think it's important to note that usually these fees are actually, net of the returns, right, that are advertised in the deal. And I think what's confusing, right, is a lot of people are coming from the Wall Street domain, where fees can actually be buried in an assets under management type structure. But in this case, the advertised return is your advertised return, and the fees are really kind of separate for that. But in my experience, I actually like to see fees, and I think fees can be good because you want an operator that's investing in their business. They have a good investor relations team, right? They're using good legal work, right, to be able to kind of support their business, because this is a long-term business, right? You're in the deal for at least 5 years. So ideally, you're working with, top-notch people who should be compensated, right?
Yeah, and that's a great point. And we'll advise clients the same, especially the ones that are coming in first, second, third go round, that at the end of the day, you've got to have some monies coming in, because one, Murphy's Law, there's going to be some sort of unanticipated cost, right? And then you do want them to be compensated and be focused on that particular project. Absolutely.
Yeah.
Absolutely.
Yeah. And I like what you talked about as well earlier. And I think, this is a big question. A lot of, people who are new to the space, it's good. I like to talk to people about, how I'm compensated. How are the GPs really compensated in a deal? How does it work? Because it really does come down to that mutual alignment of interests. Right. And when you have that hurdle that you were talking about at the end, that's actually an incentive, for the general partners to actually exceed the business plan, and provide greater returns to the investors, and everyone wins. So those are the types of, mutual alignment and incentives that are really, nicely structured in these things. And again, when I compare that to Wall Street, look, we're just coming off of April, one of the worst months, in quite a while. And, they're just still collecting assets under management fee, whether the market goes up and performs or it goes down and doesn't perform, they're just still collecting their fee on that. Whereas this is a completely performance driven model, based upon, a 5-year business plan.
Yeah, the other piece that I would advise an LP to take a look at is how your capital account is treated. And so what you'll see, and it varies from sponsor to sponsor, but what I mean by that is you're going to get really distributions 2 ways. You're going to get distributions from cash from operations. And then when there's some sort of liquidity event, you're either going to be bought out or you're going to participate in the upside, whatever it may be. But the capital account, when you put your cash into the deal, that starts a capital account for you. And on occasion, sponsors will have a preferred return that's based either on the initial capital contribution, and that will stay the same throughout the life of the deal, or they'll base it on the capital account, which can be reduced over time. And so that's a very nuanced thing to look at from the LP side of the house. Is when my 50 grand goes in, or whatever, that let's use 50 grand, my 50 grand goes in, and I start getting some cash from operations in the form of the preferred return, and then some sort of split above that, what does that do to my capital account? Does it keep it the same? Does it reduce it? And how does that interplay with the pref? Because it's a very important distinction to understand that piece. Most often what you'll see is that the return of the preferred return is not treated as the return of your capital. And so you'll see it on the K1, there's a particular spot where that is addressed almost as if it's like an interest payment on a loan. And then anything above the pref would reduce your capital account. So that's just something, and that's higher level, looking at a PPM, those are the kind of things that you got to really take a hard look at.
Yeah. Yeah, no, that's a great point on that one. And anything else with respect to the PPM, or really just, I guess at this point, even due diligence overall, that would be important from an LP perspective?
Yeah. So like we were talking about a little bit earlier, there's some pretty good lessons learned that have come out of the last few years. One example is property taxes, right? So if you have an opportunity to take a look at a PPM or an underwriting model, take a look at the property taxes, because what's happening a lot of time, especially in these off-market deals where you're buying from a mom and pop operator, is they've owned this thing for 20 years, right? So they bought this thing, for $300,000 20 years ago, and you're about to purchase it for 2.5 million. Well, their property tax is incrementally increased based on the assessor, right? And the property tax, when you actually purchase it, could be triple, quadruple. I mean, it could be a multiple of 10 from what they're paying at the time of purchase, right? Now, there's a mechanism where you can go back and dispute this with the local county, but at the end of the day, the county is going to say, look, you bought this at 2.5 million. That's the market value. So we've got to increase the property taxes based on some percentage of that market value. And so people don't build that into their underwriting model. And now all of a sudden, they're paying way more property tax than anticipated. That's common. Take a look at, on the PPM side of the house, there are risk factors, right? And so again, matter of public policy, trying to inform the investor on here are all the potential things that can go wrong. And so when we build ours, we start high level with just what's going on in the world and how that may affect certain things. So the stock market, interest rates rising, the war in the Ukraine, supply chain issues, high level stuff that's going on in the world. And then we dig down a little bit into real estate, right? How is real estate being affected by some of these other factors? Then we dig a little bit deeper into maybe the asset class, if there's some risk associated with this particular asset class. And then we go into the geographical location of the property. And so, for example, there are some properties that are highly dependent on one particular industry. So think oil and gas, right? So if you're purchasing an RV park or mobile home park or multifamily somewhere that's heavily dependent on oil and gas in that industry, well, fluctuations, depending on who's in charge and how oil and gas is treated can really affect your occupancy rate, your market rate for rents, that kind of stuff. And so take a look at, in the PPM, take a look at those risk factors and see if the operator is addressing some of those things. That's pretty important.
Yeah, it makes sense. Perfect sense. Great. Anything else you want to talk about, Byron, really from a legal perspective before we, switch gears and really talk about, what you're doing on the investing side? Any other things that would be relevant to share?
Yeah, this is something that we're kind of working through right now. This is something that I would share with like first, second, third time real estate syndicators is, again, there's this natural progression. The first time you buy an investment property, you're using the local credit union or you're using whatever local lender. You get into a little bit bigger property, maybe you have to use a different lender, somebody who's nationwide, right? And then when you start to get into these larger deals, there are lenders out there that have very specific requirements on the structure of your organization. And so it's very common that you basically graduate from doing business with a local credit union or the same lender, and you provide them a PFS and you provide them a project overview and you show them pro formas and they get an appraisal and you're off and running, right? When you graduate into these more sophisticated New York type lenders, CMBS lenders, your structure of your organization is going to change. They're going to require maybe one or two additional entities, a borrowing entity, a pledger entity, and then your special purpose entity that you're forming for the purpose of raising money. And then they have lenders counsel on the other side. And so when you're trying to underwrite a deal, you got to take a hard look at the type of lender that you're using and what their lender requirements are, because your legal fees can go from 10 grand to as high as $100,000 depending on the type of lender that you're using. So you want to be very, very clear up front and make sure you incorporate that in your underwriting model.
Interesting. Yeah, that's a good point. So Byron, we talk on this show a lot about wealth strategy, right? And we kind of see this as an overall strategy of really how to grow your wealth, right? Where there's multiple different areas, right, that can impact different things, like having a very strategic tax plan, proactive type tax planning, right? Investing in tax efficient type assets and everything. And kind of as you piece this all together, right, it's this kind of holistic strategy that can provide more exponential results, right? Versus, again, typically coming from that Wall Street model where we're just looking at a singular rate of return, right, on a particular investment. So tell us a little bit about your personal wealth strategy and, how that's kind of evolved into REI Keyholder for you, and, some lessons maybe that you've had on your own personal wealth journey.
Yeah, no, that's great. I love that. I love sharing this. We do a lot of mentoring and coaching, not with just clients, but just people in general. Love having these discussions. And so right now, the way that my wife and I are approaching kind of our 3 to 5 year plan is we're intentional about buying at least one property with just us in a given year. We typically do 2 or 3. At least one property in a joint venture arrangement with a good friend of mine he brings the capital to the table. We conduct the operations, the renovations, we do the legal work, we do the marketing, we do the property management. So that structure works well. He just kind of gives us the money and he gets to participate in the deal. And then syndicating a deal, like to do one of those 1 or 2 per year, right? We're not trying to build a huge real estate empire or a huge operating company, but between that and then optimizing our firm and prepping that for sale at some point, somewhere down the road, that's kind of our approach. We invest a little bit here in stocks, bonds, and mutual funds, but real estate for us is huge. And it's been a really fun journey. It's very typical on these kind of shows to talk about Rich Dad, Poor Dad, right? Robert Kiyosaki,
Sure, yeah.
Kind of changing everybody's paradigm. And my wife kind of grew up in that, pay down all your bills, have no debt, let's invest in stocks, bonds, and mutual funds, that kind of stuff. And for me, having owned real estate, I bought my first property at 20. When you see how depreciation works and you apply that to your financial model, like it just,
yeah.
And so, yeah. So we had this kind of relationship for, the first few years of our marriage where we would live in one house, live there for a couple of years, move to another house a mile down the road, rent that out. And then we would use the personal residence exemption and sell both of those off, right? So non-taxable event. So that effectively funded what we're doing now. So I think we made like 250 grand in equity, at the sale, and used that to fund additional real estate purchases. And so we bought our office where we office for the law firm. And so that's appreciated probably $500,000 in the last 3.5 years. And then in the little area in Colorado where we invest is kind of this little honey hole that a lot of people are just starting to figure out. And so it was neat. Our first investment property where we actually deployed capital rather than just use the personal residence exemption. And I want to share these numbers with you because this is what kind of was that aha moment, and brought her into the fold in terms of doing this stuff, almost full time. Is we bought this little 3-bedroom, 2-bath house down in Canyon City, Colorado, 155,000, I think. So we put 15% down, and then we furnished it. It had already been painted and renovated and whatnot. So all in year one, I think we were, 35 grand. At the end of the day, between the rental income from short-term rentals and then longer-term furnished rentals with that property, I think we made, 50 grand gross in year one, and like a 30 net somewhere in there.
Yeah.
And then applied depreciation, right, to offset some of that income. And so you look at that cash on cash return year one with the application of depreciation, our return was just nuts. It was, 65, 75, 80%. And so compare that with this typical stock bond mutual fund where, to your point, you're paying a fee regardless whether they perform or not. People are doing backflips if they're making 6 to 8%, right? In the stock market, here we're making a 60% return.
Yeah.
That property in the last 3 years appreciated such that we just pulled out 120 grand in equity for other deals. So that's not even including that, right? Not even including the refi.
Right.
So that, again, natural progression that turned into a duplex purchase. And then we got into what I really like to talk about, and that's our historic buildings. And so we found this really neat little niche. And there's a handful of people that are doing it. but it's pretty niche and it does take work. But I like to walk you through one of the deals, and I actually posted this in the show notes. This is the Orecchio building, but we found this property. It was right next to the duplex that we had purchased. It was a two-story mixed-use building that had a brewery on the first floor and a motorcycle club on the first floor, right? So the two commercial spaces were rented, but the second floor of the property had been vacant since at least the 1960s. And it was at one point an 18 bed hotel room. And so we took a look at the National Historic Registry. The building is in a district and it's a contributing property on the National Historic Registry. So what does that mean? Well, if you jump through a couple hoops, that's really submitting a Part 1 and a Part 2 application to the NPS. Your renovation budget, as long as your renovation and your scope of work takes into consideration these NPS standards, you can recoup up to 55% of your construction costs and tax credits.
Wow.
So, yeah. So, on the surface, it's like, okay, well, that's great. If I have passive income to offset, that's great. I can apply those tax credits. But the beautiful thing is there's actually a market for these. And so you can go take those tax credits, right? You sell them on the market for 90 cents on the dollar, and you actually get that capital return to you. So this particular project, we bought it on an owner carry note, 300 grand. So we put 60 grand down. We had a balance of 240 grand. The renovation is going to be about 1.7 million, but we're going to get about $850,000 in tax credits back, which we will then turn and sell for a capital injection of 750 grand. And so now we take that capital, we're going to pay off the owner carry note. We're going to furnish 4 of the 9 apartments. We can potentially pay back some capital and then pay down the debt to where we're walking into a building now. It's worth 2.5 million and we owe about 700 grand. It's a crazy program. Yeah. Wow. It's amazing.
Yeah. That's really interesting.
Yeah, so we're doing that. We've got 4 projects using the exact same business model.
Nice.
And it's really cool. Yeah.
Yeah. I think this is really underestimated by people, but there's so much creativity that goes into real estate, right? It's really all about your imagination. And, I've seen everything from, people putting in pet parks, and then now you can charge additional fees to, valet trash service, to, adding additional parking spots and then bumping up rates, right? I mean, there's just so much creativity in this. And then, we also talk in our strategy that, how important financial education is, right? And getting smarter about these kind of things, because this is not the advice you're going to see on CNBC. You can only get this type of information from, podcasts, from books, people who've spent lifetime figuring out these kind of strategies, right? And how to kind of deploy them. So I always really encourage people to, to learn as much as they can. And then, if you can niche down into something like you've done there, that's really awesome, Byron.
Yeah, it's so fun. And then just literally bringing these old buildings back to life. And this little community down here that we invest in, there's obviously a shortage of housing, which you have pretty much everywhere, right? So we're adding 9 new units to the inventory with that building, another 11 with a building that's a block and a half away. And then we just closed last week on another that's going to add another 10 units to the inventory. And it's just these neat, quaint little towns, and people are super appreciative. And it's just really fun to see as these things progress, right? You're actually building something. Like, this is what I wanted to do as a kid. I wanted to build stuff, but I can barely change a light bulb without a YouTube video or an instruction manual. So this is where I get to play, is figuring out how the money works and finding the deals and working with the general contractor. It's just a lot of fun.
Awesome. So if you could just give one piece of advice to our listeners around accelerating their wealth trajectory, what would it be?
I think you have to, you don't have to be an expert, but you have to conceptually understand how taxes work and the various sources of capital, right? And so what I mean by that is, when I was growing up, we weren't wealthy, as son of a single mom. She's a wonderful woman. We didn't have a lot of money, right? And so the notion of being able to buy buildings and buy real estate, to me, it was always very frustrating because I never had the balance sheet. And then, but if you learn the different sources of capital, how to use other people's money, how to get creative with the tax credits, how to get creative with certain things, you can do almost anything, but you've got to spend the time understanding how capital works. And then again, taxes. And I gave the example of personal residence exemption. I gave the example of the historic tax credits. Another thing that is really been amazing to me is the real estate professional tax designation.
Yeah.
And so I don't know if you guys have covered this ground before or not, but it's probably worth looking into. But I was able to, in the last 3 years, use that tax classification to reduce my taxable income to almost nothing, right?
Yeah.
It's really powerful stuff if you can understand how to navigate those waters.
Yeah. Yeah. And just as an overview for folks, I mean, that's basically if you're doing real estate related activities, I believe it's 750 hours per year, Byron. As long as you're doing real estate activities, you have documentation that you can justify for that. You can essentially offset active income with passive losses, right? So typically in these deals, we're taking passive losses to offset the passive income. But with this designation, you can actually offset active income as well. So I know a lot of, doctors, dentists, people who are exiting businesses, and they transition directly into real estate so that they can get this designation.
Yep, it is so powerful. And, with good tax planning, like I said, we acquire numerous properties in a given year, but we'll take a look ahead. Okay, what is our taxable income on the ordinary side of the house? So I can estimate based on my military retirement pay. My wife is actively serving in the Army Reserve, so she has ordinary income coming in. And then we have stuff from the firm, both in terms of when we payroll ourselves, but then the distributions at the end of the year. So at the end of the day, we're trying to take, okay, what is this dollar amount? And then given the properties that we have, if we do a cost segregation and accelerate that depreciation, what do we need to do to reduce that to almost nothing? And if you understand the concepts and you're getting out ahead of it and planning instead of reacting when it's time to prepare taxes, it can save you tens of thousands of dollars. It's amazing.
Yeah, that so resonates with me. I fired actually 4 different CPA firms over the years of running different businesses. And, one part of it was also the, non-predictability of understanding your tax implications. It would always be March, April that you're scrambling because you have some, large 6-figure tax bill that, it just kills your cash flow, right? You thought you came off a great year. But once I finally moved to, a proper tax planning and tax planning strategy, now I do a December forecast. So I know exactly what my year looks like, and I can change things, within the year, within that calendar year, if I need to adjust some things. But you're right. I mean, it is very clear. And I think people don't realize this as well, is that, with, real estate, some of these assets and these techniques, you can get your taxes to zero. You can completely get them to zero is possible. And that should be a big focus. It doesn't just happen. You have to get smarter on it, like you said, because, taxes are actually your number one biggest expense. So wouldn't it behoove you to spend some time, get a little smarter? I mean, even if you could make a 10 or 15% reduction in your taxes, think about what that would mean like on a perpetual basis moving forward to free up additional capital.
Yeah, it's so powerful. One of the things that, so I'm in a military mastermind, real estate investors, and a lot of active duty folks on that call. And I try to speak to this piece, like, a lot of you guys have spouses that maybe aren't working right now. It applies to your spouse as well, right? And so if your spouse doesn't have a W-2 job, but they're helping to manage your real estate investments and they're doing activities, it's 750 hours is very easy to meet. The other thing is it has to be over 50% of your time. You have to be doing that, right? So like when people ask me what I do, I say, well, from the IRS perspective, I spend 49% of my time practicing law and 51% of my time doing real estate investment activities. But if you have a spouse who's not working, it's very easy to meet that threshold, and it applies to both your incomes together. It's simple. It's simple to track, right? Like for me, we manage our own properties. And so I have a mileage IQ app that I keep. And at the end of the year, simply my drive time to visit the properties beats 750 hours. It's really easy to meet that threshold.
Sure. Awesome. Awesome. Byron, really appreciate you coming on the show today. I know there was a ton of value here for the listeners. So thanks again for that. If folks want to reach out to you, learn more about, what you're doing on the real estate side or on Three Pillars side, and I'll give a plug as well, is that, Byron is one of the attorneys that we use at Three Pillars. And it's just been a fantastic experience, and, looking forward to continuing that relationship. So really appreciate that. But how can folks, reach out, connect with you, follow you, learn more?
Thanks for that, Dave. I really appreciate that. So as Dave mentioned, our company, our firm is Three Pillars Law. So email's great, Byron, BYRON at 3 pillarslaw.com. We also have on our website, you can go in there and query and ask a question or whatever else. And we'll make sure we're pretty intentional about following up. And so those are the two ways on the legal side of the house. On the investment side of the house, it's just Byron at reikeyholder.com. And if you guys are interested in any of the stuff that I talked about, both on the investment side of the house, but the tax stuff, this and that, as you can tell, I get fired up about these conversations. I just love it. And so if you ever want to have a discussion, we don't really charge consult fees. I love talking to people and hope that we add enough value that at the end of the day, if you need some legal work, you'll consider us.
Awesome. Thanks again, Brian. Really appreciate it.
Yeah. Thank you, Dave. You'll consider us.
Awesome. Thanks again, Brian. Really appreciate it.
Yeah. Thank you, Dave.